Right. Hi, guys. Good morning. We talked about pricing um, in class on Friday, and now we're going to move on to relevant costing. I think Georgia had just left when we started talking about this. I can't remember if you were in class or any of this, but I'm going to go through. This is chapter 6. This is the chapter following on from pricing. So please do as many questions as you can on pricing. And yeah, let's go. Let's talk about relevant costing. Still very much in the realm of the short term. I sort of highlighted this last time that these chapters so far are really looking at short-term decision making. So you're still thinking marginal costing. You're still thinking we're not interested in fixed costs. So this is when we're still thinking sort of a one-off sort of scenario. So when you're thinking of these ideas of relevant costing, the other key point, I mean, we'll see this as we come along, but I like to mention them early because it sometimes sticks better that way, is we're interested in cash flows only. Anyway, let's carry on and you'll see what I mean. Okay, so we're going to be looking at make versus buy decisions. Do we make something in-house or do we buy from outside? And when we do that, we disregard fixed costs. We're going to talk about shutdown decisions. We're going to talk about one-off contracts and further processing decisions. Right. Now, here's the thing. So sometimes when it comes to making a decision, generally we have to make, if you like, we have to make a choice between 2 or 3 alternatives. And relevant costing really says that a business should only consider the relevant cash flows, so relevant cash flows that arise as a result of this decision. Now, again, this is a very economic kind of way of looking at things. And when I say economic, from the thinking of an economist, because as accountants, we just tend to look at just the costs we see at the time. But economists tell us that we should really be looking at these relevant cash flows, and you'll see what we mean by relevance in a second. But we're also looking strictly at the future. So forget the past. Accountants would consider the past, add up all those costs. Economists are saying no, in order to make good decisions or short-term decisions, forget the past. Focus only on the future. So what is a relevant cash flow? Yes, relevant. I say, what does relevant mean? A relevant cash flow is a future incremental cash flow. Future incremental. It must be incremental. In class, I think I gave the example of when you look at NPVs, and if you have an existing machine, for example, and then you embellish it or something, you make it better, you spend 10 million on it. I mean, the machine was already bringing in some sales anyway, right? X1, X2, X3, X4, and then you embellish it with an additional 10 million. Well, the cash flow, or the decision as to whether or not to make it better, is the relationship between this 10 million that you're spending on it and the additional cash flows that are coming in. So your NPV is really the relationship between all these Y's and the 10 million, not the existing worth of the machine and not the pre-existing cost of the machine, the pre-existing cash flows that came in. So this idea of relevance is really focusing on future and incremental additional cash flows coming in. And I said this already, only future cash flows that occur should be considered. I highlighted this earlier on. Some costs, previous costs, ignore. So every time you see one, ignore it. I gave in class, we talk about, sometimes I mention the idea of bear. It is rare for anyone to look back and say, I'm going to drink another beer based on how much beer I drunk in the last hour. No, you make the decision about drinking the next bottle of beer as to whether or not it will go over the limit and where you will not be able to drive. So really, again, it's about marginal joy or marginal revenue versus the marginal cost of drinking that beer. So this is how we don't consider the backlog or the sunk costs. So again, I talked about the fact that we're only interested in extra cash flows. Again, I talked about this ignoring fixed costs. Now, if you had fixed costs at the beginning, fixed costs have already happened, usually, but you might, of course, in making a future decision, incur some new fixed costs, and of course you have to consider those. So it's really saying that if you had already fixed costs from the past and you wish to make a decision, don't take into consideration those fixed costs. Ignore committed costs as they would have happened anyway. So if you had already made some decisions, to already have some things from the past, well, those costs will not, these committed costs will not affect the way your new decisions are going to be made. Right, now this issue of opportunity cost, you might have come across it before. I briefly talked about it in class. And what is opportunity cost? Opportunity cost very much is the, if you like, the next best alternative for gone. Now, this is not an accounting cost. We wouldn't do this in accounting. It's very much an economic term. And I explained really the thinking of it. But the simple idea is that every time you're doing something, you could be doing something else, even if it's pretty much sleeping or working. So every time you're in class, let's just argue that your firms weren't paying for you. Every time you're in class with me, you are losing out. If you like, let's argue your next best alternative would be to be at work, making money. That money that you're losing as a result of being in class with me is the opportunity cost. And so, yes, you may be paying £20,000 for your course, but you're also losing out over the year on another 50 grand, for example. So the total cost of the course is actually 70 grand. So 20 grand for the actual cost of the course, but 50 grand for the time lost when you're spending time with me in class. So the argument is you should always find out what this is as well and add it to the cost as well. Again, the key point here is, again, I highlighted earlier on, that only cash items are relevant. Depreciation is something they like to throw in. Remember, if you, from accounting, depreciation is not a cost. Yes, depreciation is not a cost. Depreciation is an accounting sort of an accounting confirmation of the concept of accruals, if you like. We're just pretty much trying to match, if you like, revenue with costs, which is why we create the concept of depreciation for the income statement. Okay, let's quickly do this, and then let's get to the end of these case studies, and then we'll end this first set of lectures. Let's look at the relevant costs here. The salary to pay to a market researcher. So we're intending on bringing in a market researcher, and we intend to pay a certain salary. This is a new post, so it's new. We intend to give £12,000, even though it's a fixed cost. We're not talking about a fixed cost that existed from the past. Is this cost relevant? Well, yes, it is. It's a new post. It's a new product. It did not exist before. So when you're thinking about what costs are we going to have to consider, well, you're going to have to consider that new salary and everything that comes along with it. This is a 2,500 additional monthly running costs, and this thing will save you. This thing will save you on labor time, and these costs were reduced by £100. So yes, we're talking about additional here. So yes, the 2,500 is a relevant cost, and the £100 that you're saving is also a relevant cost. So these are relevant costs. So if you like, you can argue that the net cost is 2,400, isn't it? This is the cost, and this is the saving. So you can have these scenarios. This was, I think, the third one we did. So you had this office cleaning for 125 per month. This office is cleaned by contractors, and the contract can only be cancelled by giving 1 month's notice. So if you decide to close the office today, well, it doesn't matter. You're still going to have to pay this 125 for next month. This is a committed cost. But there's nothing you can do because you must give a month's notice. Fair enough. If you were to close, if your planning was to close in 2 months, well, yes, the second month the 125 will become relevant, because if you gave the notice today, you wouldn't have to pay in 2 months for the cleaning of the offices. And finally, you paid £75 to a marketing manager traveling to see a client. And if you're going to continue negotiating, is the 75 relevant? No, this is a sunk cost. It's happened in the past. He's come back, he's told you the news, and you start planning for the new set of negotiations. So this becomes a sunk cost and has nothing to do with the making new decisions. We're not talking about accounting here per se. We're not talking about preparing the income statement. We're just talking about what would be the relevant costs for going forward. That's the issue here, going forward. So, and we want the relevant costs, so we can't be looking back. Okay, so this is a sunk cost. Great stuff. We'll continue in the next set of videos, but I'll end it here for you to take a little break. All right, see you then.